What is up, everyone? I'm back, and welcome back to you. I wanted to do an update on the stocks that I covered last year, just in case you wanted to know how those companies are doing. And, well, they're doing very well. At least they all are except Google. But that's okay, because in aggregate, those stocks are beating the S&P by a solid 18% over this past about 4.5 month time period. So this little portfolio is doing quite well. So I did want to just kind of update everyone on my positions, my take, my analysis, and the valuation, just to see how attractive these stocks still are to date, because I have made some changes. So that said, let's get right into it. So first off, I do want to say I did not include AMD, even though they've done pretty damn well, 28%. So they're beating the markets by a pretty good margin. But I'm not going to include them because I technically didn't get into a position. I did get into a pairs trade on them, and that's doing well. But my take at that point was to sell cash secured puts at $50 strike price, and we never got down to that level. And I was just trying to be cautious because I think there were red flags. That were there when I was covering the stock. But I'm not going to include them for sakes of demonstrating the outperformance of the other stocks and how well they're doing compared to the S&P in aggregate, that is. So Stellantis has had a hell of a run, about a 46% price change since we covered them in the last video, or the first video about Stellantis. You can see the prices here. These are the prices that these stocks were at the time that I covered them last year, and these are the market prices here. So 46% increase, hell of a run. And I think bull side cases, upside, downside risks, they're still basically intact. Stellantis is still trading at a damn good valuation. They still have that nice secure dividend, but we still have those potential downside risks, such as recession. Supply chain, they're managing quite well through, especially compared to their peers. And turnaround still, in progress, but management has made some pretty good decisions over the past few months that are evidencing that they're doing pretty well. They're catching up to Volkswagen. They're catching up in key markets, and they're positioned quite well. So, and the balance sheet's still really good. This stock, in addition to Meta, Google, and Palo Alto, they all had earnings reports since I covered them in the videos last year. So all of them doing pretty damn well. Stellantis is no exception. So for them, I am adding, even though they've had that terrific run up, I'm still going to add because they're still trading at a pretty damn good valuation. And I think dollar cost average is the way to go there. And we'll get into the valuation in just a minute. Meta was crazy, had a massive drop. When it was about low 90s, I picked up a bunch of calls, and I made a hell of a lot more money than this 41% rally since we mentioned them, since I mentioned them in the last video about them. So, even with that drop, I think it was a bit irrational, but maybe I suppose the markets changed their minds. They corrected. They realized that the company's strong, right? And this tends to happen over time. If the company is good to go. And same with Stellantis. I think the upside and downside risk are still in effect. Fundamentals are still strong. Financials still good. A bit of a different valuation after this recent price run up. But that's why I'm trimming this position. So downside risks are still in effect. I think people might suddenly decide again that they want to hate Zuckerberg, So I think that's a massive risk, even though the company's financials are good to go. But I did trim the position. I trimmed at around $190 stock price, and I trimmed about 80% of that position. And at that point, it was a lot of calls, but I trimmed about 80% of the shares I held as well. So the valuation is a bit different, and we'll talk about that in just a minute. I still think it's a good company. I still want to hold a little bit, but because of the valuation, because of the price run up, I am trimming. And like I said, we'll go over that in just a minute. Google is the laggard, down 7.5% over this time period, which frankly I think it's a little overblown, especially compared to the other communications stocks, which had a pretty good rally over the past 3 months. And I suppose Google, it's because of ChatGPT, risk from other platforms coming up with their own AI search features, etc. Even though Google's working on their own, which is Bard, and they're all flawed. They all have very similar flaws, and I don't think anyone really knows the extent of their usefulness. So I think there's a lot of hype around it. I don't think Google's business, I don't think their balance sheet is at high risk from anything related to AI. Sure, there is some risk, but for $100 billion, $150 billion to be wiped off the market value, I think is quite overblown. So they are the laggard here, but upside risk still intact, still low debt, still repurchasing shares, good liquidity, and I think they're in a very defensible position in relation to the AI threat, whatever that is, right? So I've already added, and I will be picking up shares at about the $95 strike price this Friday, I think. And I am adding some calls as well because I think Google's good to go in the long run. And they're still trading at a good value as well. Palo Alto, they're up about 18% since we last mentioned them. They had a very strong earnings report. They're still in growth mode, high growth, I would say. Upside, downside risk are still mostly intact, still pretty low debt, industry leader. They are bucking the competition. And, as with all these other stocks, it's always a risk of recession. And to me, I'm more worried about share issuance because the execs seem a little greedy there. So hopefully they reduce share issuance going forward and try to protect their margins and, stop diluting the stock. It's not that bad. It's like 1%, maybe 2% a year. But still, I'd rather them not take money from the shareholders. They're making a lot of money. They don't need to issue that much stock-based comp. So for several reasons, mostly because the prices had a good rally, I think they're about fairly valued here. And I think that's me being conservative. Some people might say it's still a buy, but I think it's fairly valued. That was a dollar cost average approach when I mentioned them last year. But I'm going to continue holding. I did cash out some shares, but I still do have a pretty good sized position because I think they've got a lot of momentum in the stock price. All right, so here's a nice nifty chart to look at the stock price performance of each of those stocks relative to the S&P. S&P is here in gray, Google's in red, Palo Alto is yellow-orange, Meta's in blue, Stellantis is in green. So just kind of visualize that in aggregate, 18% outperformance of the S&P. Obviously, without Google, it'd be beating a lot more, but I'm going to include Google because, that was one of the analysts, and I said Google was a good buy. I got into them. So that's for these stocks specifically in aggregate, 18% outperformance. Not bad over 4.5 months. That's pretty damn good. And then if you played the bottom for some of these stocks like Meta, the way I did, you're doing even better than that. So yeah, good outperformance there. All right. So valuation, Google still very low debt to EBITDA. Mind you, these are forward estimates, right? So still very low debt. Free cash flow yield 7%. So that's still solid. They're still in growth mode. As you can see, revenue growth 6% expected for the next 12 months. Margins are still pretty damn good. So yeah, it's a growth and value stock to me. So I'm comfortable adding to my Google's position. So yeah, good to go, I think. So yeah, Meta, 4% forward free cash flow yield is quite lower than the 8 to 10% that we were looking at the beginning of this year, end of last year. So simply because of the strong rally in the share price, that's why I've reduced the position by 80%. But again, I still think it's a strong company. They're still growing. They should be good to go over the long term. They have identifiable risk, I think, regulatory risk, Zuck, right? But I think they're still a strong company. I do want to add to them if the stock price drops back down, but there is a lot of opportunity costs here. I mean, one of them being Google. You can see the comparison here between them, right? So yeah, I'm gonna wait to add back into Meta, but yeah, for now, I'm keeping that position rather small until this free cash flow yield, forward free cash flow yield goes back up. Palo Alto had great earnings report, still solid growth. Forward free cash flow yield is 5.2%, still in growth mode, high growth mode. Next 12 months, they're expecting about 20% revenue growth. So this is pretty damn good considering that we're about to be in a recession if we're not already. But yeah, the margins are still good. Ignore this EBITDA because it includes stock-based comp, and I'm not considering that for the free cash flow yield. Despite the fact it does have an impact on shareholders, I just want to see the business margins of the business itself. So yeah, Palo Alto is still good. I'm going to keep holding them. I wouldn't add to them, but I do like the strength of the business and the fact that management is still growing revenue at a pretty high rate. Stellantis, my all-star, my love, the stock that I want to be the biggest position in my portfolio. I'm going to keep dollar cost averaging, 36% forward free cash flow yield, and a 6.3% forward dividend, which is definitely safe. So yeah, this stock is good to go. Less than 1 times debt to EBITDA. They can make acquisitions and speed up their transition to a full EV-based company. It's going to take some time for sure, but I'm all for Stellantis. They've been making great decisions. They're managing their supply chain issues rather well, especially compared to other auto manufacturers. And their valuation it's just unbelievably good compared to the rest of the sector. So there's no competition here for Stellantis in terms of valuation. Even the company is outperforming its peers. So or just from a business standpoint, it's outperforming its peers. So I'm definitely adding. Dollar cost average, I think, is a good strategy to continue to do because of recessionary fears, and just in case stocks just have a big correction, or the Europe stock market has a good correction. So yeah, still definitely bullish on Stellantis. But yeah, so adding to that, I think add at this price for Google is a good decision. Meta, kind of holding for now. I want it to drop back and down. Maybe free cash flow yield gets back above 6%. And I am worried about their forward estimates because I think I don't know if markets have priced in the lower cash flow that they're expecting for this year, and it's substantially lower than what it was the past few years. So I'm not sure if markets have priced that in yet. So I'm just going to wait for Meta and see if I can get back in at a much better price. Palo Alto, I'm holding because it's strong business, good momentum. So yeah, so that's it for the updates. Beating the markets by 18% in aggregate, pretty damn good, I think, in a 4.5 month period. Not bad. So that said, I did want to turn people's attention to my Discord. It's called Happy Trading Friends. I think it's a pretty good place. We got a good amount of smart people. There's not a lot of degenerate behavior here. I try to keep that limited. And as you can see here, we have some decent posts. It's not just me posting stuff. It's other people sharing their ideas on potential value plays. Here, we'll have like full write-ups. At least I'll do full write-ups of my analysis. So I'm much more active in Discord than I am on Reddit or YouTube, obviously. So yeah, if you're interested, go ahead and join the Discord. I'll include the link in the description below. There's Hulk Hogan. But yeah, have a lot of good sources, and even a whole channel dedicated to it. A whole bunch of sources that I think would be really helpful to not just value investors but traders as well, because we do cover specifically options trades. Even have a channel for market research, Moody's, FactSet, you name it. So this is basically my hub for my personal work, managing my personal portfolio, and I share basically everything that I research here in the server. So do join if you're interested. And speaking of this, I might do talks on Discord going forward. They're shutting down Reddit talks, so I might go ahead and shift those talks to this server. Maybe do those on a weekly, maybe once every other week. But it's either here or Twitter Spaces. But I'm not really sure about Twitter Spaces, and frankly, I don't care that much to put a lot of effort into the talks. So if anything, I might do them here, in addition to doing more videos on YouTube. So those videos I still want to keep doing. I want to get back into, and I definitely want to cover other stocks, because there are a ton of other stocks that I've added to my portfolio. So yeah, join the server, join the Discord server if you want to keep up with everything else I'm covering, all the other research that I'm doing, and all the other stocks that I'm currently buying or trading. So, yeah, that said, that's the update. Not bad. Beating the S&P by 18% over 4.5 months. Pretty damn good. Google made me sad, but that's fine. It's a good company. It's a long-term hold. So yeah, good luck to everyone. I'll do some more videos soon and cover all the other stocks that I've been talking about, or at least in the Discord server, and perhaps some other videos on, maybe like cyclicality in stocks. I kind of want to do a video on book value traps, which I think would be interesting. So hopefully I'll get back into doing videos on, a lot more frequently than I have been in the past. So that's all I got. Thanks for tuning in, and I will see you next time. Cheers.